Welcome to the deep dive. Today, our source material is the big one, the Q4 2025 earnings call from JPMorgan Chase. We're jumping straight into the numbers, the strategies, and the risks as defined by, well, one of the world's biggest financial players.
And our mission for you is to really take the key insights from what the CEO and CFO said, the big figures, the little footnotes that matter, and where they're signaling risk, and just make it all actionable. We want you to be instantly fluent in what's happening, especially around consumer health and where the big banks see threats emerging.
Okay, let's unpack this before we even get to the weeds of the fourth quarter. What's the big picture for the full year? What were those headline numbers that really set the stage?
The full year results were, they were stellar. They really set a powerful benchmark. If you exclude some of the one-off special items, JPMC delivered a net income of $57.5 billion. But the metric that really tells the story of their health is the return on common equity, or ROCE. It clocked in at an impressive, really robust 20% for the full year.
20% ROCE. That's often seen as sort of the gold standard in banking, isn't it? A very high bar to clear.
It absolutely is. It signals just superior efficiency and profitability with the capital they're using.
So for someone listening who's maybe prepping for a meeting, what does hitting that 20% number really say about the company's underlying strength?
Well, think of it as how they're using shareholder money to generate profit. A 20% figure suggests they are executing on strategy, they're growing, and they're doing it all efficiently. It is, a real statement of operational excellence.
And that foundation is key because the fourth quarter itself had this massive singular event that really complicated the picture. We're talking about the commitment for the Apple Card portfolio acquisition.
Yeah.
What was the immediate hit from bringing that onto the books in Q4?
The immediate hit was in the Consumer and Community Banking Division, the CCB. In Q4, they had a $2.2 billion reserve build, and that was tied directly to that forward purchase commitment for Apple Card.
Okay, let's clarify that for the listener. A $2.2 billion reserve build. In simple terms, is that a loss they actually took in the quarter?
No, it's not a realized loss. It's more of a required accounting move. It's proactive. Because they've legally committed to taking on that portfolio's risk, they have to immediately set aside capital to cover potential future defaults, even though those losses haven't happened yet.
Right, and without that specific build, the CCB's net income would have been, what, $5.3 billion instead of the $3.6 billion they reported. It's a perfect example of how a big, long-term strategic move can mask strong day-to-day results.
Exactly. But the bigger impact really is on the metrics that regulators watch so closely, specifically risk-weighted assets, or RWA.
And why should our listeners care so much about RWA?
RWA is basically the foundation of modern banking regulation. It's a measure of how risky a bank's assets are. And the higher the RWA, the more capital the bank has to hold, which, can limit their ability to lend or do other things. It's the engine of the balance sheet.
So when a huge credit portfolio like the Apple Card lands, how did it change their RWA? We saw two wildly different numbers in the source material, $23 billion and $110 billion.
Right. So that gets us into the difference between standardized and advanced RWA. The standardized RWA, which added the $23 billion, you can think of that as the simple baseline calculation. It's pretty straightforward.
And a staggering $110 billion number, that must be the advanced calculation.
Correct. The advanced RWA calculation, which is the one that spiked to $110 billion, it uses the bank's own internal models. So it's highly sensitive to these kinds of big, sudden additions. The reason it was so high is that the calculation immediately had to factor in not just the money people had already borrowed, but all the undrawn lines of credit too. So they have to recognize the full potential risk of the entire portfolio at once.
And that massive spike creates a real, even if it's temporary, a real challenge for their capital position.
It does, but the key takeaway is that the bank really stressed this elevated $110 billion level is temporary. They expect it to drop substantially, down to about $30 billion in the new term. But for Q4, that initial spike was the dominant story for their capital metrics. It shows the real upfront cost of doing a deal like this.
Okay, that definitely clarifies the strategic cost. Let's pivot now away from that one deal and check the overall pulse of the consumer. The bank said consumers are resilient, but we all know that consumer sentiment has been pretty weak. What data did they point to back up that claim of resilience?
Yeah, that's what's so fascinating. There's this clear disconnect between how people say they feel and what their actual financial behavior shows. The report found trends are consistent with historical norms, no real deterioration. And the most powerful proof point was this. Debit and credit sales volume was up 7% year on year, And that's across all income groups.
A 7% increase in spending is a huge vote of confidence. But couldn't that just be driven by higher prices, inflation, rather than people actually having more capacity to spend?
That's a very fair question. And inflation certainly plays a role in the nominal dollar increase. But the bank's confidence comes from the fact that the quality of the portfolio is still strong. Delinquency trends are favorable. They wouldn't call the consumer resilient if they thought that 7% increase was just people struggling to keep up with costs by going deeper into debt.
And that resilience powered some serious franchise growth in 2025, right? They weren't just keeping customers, they were taking market share.
Oh, they were. For the full year, the growth was remarkable. 1.7 million net new checking accounts and a staggering 10.4 million new card accounts. They also hit record households and saw major growth in wealth management. It's really broad-based expansion.
So with all that consumer success, did that momentum carry over to the big institutional side of the business, the corporate and investment bank, or CIB?
The CIB story was more of a mixed bag. Overall, CIB revenue was up 10% year over year, which is strong. That was driven by markets, payments, and security services. But underneath that, investment banking fees were actually down 5%.
A drop in fees. That usually means a quiet period for big deals. So what made up for it?
Well, the drop in IB fees was partly due to a tough comparison to the prior year, and also some big deals got pushed into 2026. The real surge came from their trading desks. Equities was up 40%, a huge number, especially strong performance in prime services.
And that kind of trading strength would naturally flow into asset and wealth management, or AWM.
Absolutely. AWM saw record client asset net inflows of $553 billion for the full year. Even just in the quarter, long-term net inflows were $52 billion. So the message there is stability and very successful client acquisition.
Okay, let's move on to our third big topic, non-bank financial institution lending, NBFI lending. This is an area where banks face a lot of scrutiny about hidden risk, and it got a lot of attention last quarter. So for you listening, we need to understand how JPMC defines and manages this $160 billion exposure.
This is such a crucial area because the official regulatory definition, what's on the call report, is incredibly broad. JPMC made a point of saying that to manage the risk properly, they use a much narrower internal definition, one that focuses on where they're truly exposed to the underlying credit risk.
Okay, so what's the key filter in their narrower definition? What are they looking for?
The key filter is collateral. Their definition focuses on exposure that is directly collateralized by the loans that the NBFIs themselves are making to consumers or businesses. So the bank has security against the actual loan pool.
And what does that exclude? What's left out of their definition that others might include?
The big one is subscription lending to private equity funds. Subscription lines are loans secured by the binding capital commitments of big institutional investors. That's seen as a totally different and much lower risk profile than being exposed to, say, a pool of consumer loans.
So even using that stricter definition, their exposure was still about $160 billion. Given all the growth in shadow banking, how does the bank defend that level of exposure?
Their defense really centers on two things: structural features and credit enhancement. We're talking about very sophisticated deals that are layered to absorb shocks.
Can you explain that a bit more? What do those structural features look like in practice?
Well, it's about subordination. So the bank might hold the safest, most senior piece of the debt. The non-bank institution, or other junior investors, they agree to take the first loss if things go bad. That creates this huge buffer. The bank's capital only gets hit if defaults are so severe that they completely wipe out that first loss cushion.
And their track record suggests that this defense works pretty well.
Extremely well. They said they've seen only one charge-off in this category since 2018, and that one instance wasn't even related to the market, it was due to apparent fraud.
So their view is that any future losses will come from either more fraud-like events, which are unpredictable, or a recession so deep it wipes out all those protections.
Precisely. And they added some really critical context here. They said if we're in a recession that deep, the losses from traditional unprotected lending, your standard mortgages and credit cards, would be a far, far greater concern for the entire industry.
That puts it in a much clearer perspective. The risk is managed and contained unless the whole system is under extreme stress. Okay, let's move to the future. What's the outlook for 2026, especially on interest rates and income?
So the outlook really hinges on the forward curve for interest rates. Right now, the bank is basing its forecast on the assumption of 2 rate cuts in 2026. That assumption drives their projection for net interest income, or NI, to be about $103 billion for the year.
And they gave a separate number for NIX markets. What's the significance of that?
Right, so net interest income excluding markets, or NIX markets, is projected at about $95 billion. By breaking that out, they give investors a much clearer view of the stable, recurring income from their core business of deposits and loans, separate from the more volatile trading-related income.
Got it. Now for the other side of the equation, expenses. The forecast is for about $105 billion in adjusted expense for 2026. That is a staggering number. What's the rationale for committing that much capital to spending?
The bank called it structural optimism about their opportunity set. They're betting they can grow revenue even faster than costs. But the most revealing part was about competition.
What do they say specifically about the competition?
They said the environment is only getting more competitive, and this level of spending is necessary for investments to secure their position against both traditional and non-traditional competitors. It's a clear statement that they are spending to win, especially in technology.
That $105 billion is a huge bet. I mean, what kind of non-traditional competitors could be driving that kind of spending?
They're worried about disruption everywhere. That budget is about investing in AI, in global payments to compete with a Stripe or a PayPal, and deep tech integration to defend against big tech. It's all about maintaining a technology edge when fintechs are constantly chipping away at their services.
It's a powerful signal. The battle is being fought on the expense and innovation line. So finally, to close out the outlook, let's bring it back to the consumer. What's the credit forecast?
It continues that theme of resilience. The bank expects the 2026 card charge-off rate to be approximately 3.4%. That forecast is driven by those favorable delinquency trends and the continued underlying strength of the consumer that we've been talking about.
Okay, let's synthesize this. The bank's health in 2025 was incredibly strong. That 20% ROCE proves it. But the quarter was really defined by the huge strategic move for the Apple Card, which caused that temporary but massive $110 billion spike in advanced RWA.
Exactly. The foundation is solid, built on consumer resilience. That 7% sales volume increase is the proof. And they're managing these specialized risks, like NBFI, with very robust structures, basically saying the real danger is in economic collapse, not in the products themselves.
And they're backing all of this with that enormous strategic $105 billion expense forecast to fight off competitors. Which brings us to our final provocative thought for you to consider.
If a giant like JPMC feels it has to spend $105 billion betting on its own optimism and future tech, what specific capabilities are they seeing in their non-traditional rivals, the fintechs, the payment providers? That makes that extreme level of investment necessary.
That decision to spend $105 billion is the real story. It's their fear and their ambition all rolled into one. It tells you exactly where they think the next great financial disruption is going to come from. So think about the nature of those necessary investments.
The deep dive continues, and there's always more to learn.
Find us next time for another deep dive into the sources.